The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, Planning Ideas for 2026. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. Before I turn the floor over to Linus, we're going to vote on the May webinar. And as a reminder, on April 1st, we will discuss Roth conversions and rollovers. So mark your calendar for that one. The topics that are up for your consideration for the May webinar are dealing with missed RMDs, IRS updates 1099-R reporting for QCDs, life insurance and charitable LLCs. I'm going to give everybody a minute to vote, and then we will move on. But get those votes in. All right, it looks like all of the votes are in, and in May, we will be discussing life insurance and charitable LLCs. So thank you for participating in that. And with that, I will turn the webinar over to Linus.
Welcome, everyone. I'm pleased that you have joined us for today's webinar titled Planning Ideas for 2026. Today's session is part of our webinar series. Each of these webinars is open to those in the life insurance industry and the financial services industry, and they are free of charge to those who attend. Before we begin today's seminar, I'd like to remind you that next month's webinar will be held on Wednesday, April 1st at 11 a.m. Central. The topic will be Roth conversions and rollovers. If you know of a financial professional who might be interested in one of our monthly topics, feel welcome to invite them to join us. So today's webinar will last approximately 15 minutes, so let's go ahead and get started. So we're going to talk about planning opportunities in 2026 and beyond, and we're going to talk about a few things that I think are relevant as we go and meet with our clients and help them to get started on on 2026 planning and meet with them in the regular course of business. The things we'll talk about today are things that perhaps should be on the agenda for the meeting as we go talk to those clients. We're going to cover several broad categories. We'll talk about income tax planning. We'll talk about estate planning today on the webinar. We'll talk about Section 401k planning. And then we'll talk about some ideas that are timeless, that can be used at any time. They aren't necessarily peculiar or unique to calendar year 2026. And then we'll touch on a few key numbers that will be relevant to you. So let's go ahead and start with income tax planning. I want to talk about three things. First of all, let's talk about the idea of Roth conversions. Why is Roth conversions on the list? Well, while the One Big Beautiful Bill Act stabilized federal income tax rates at levels that have been consistent for the past 8 or 9 years, the federal income tax rates are really at pretty much historical lows. And while that's a good thing, the fact that we've got a substantial federal debt in the tens of trillions of dollars means that someday soon the federal government is likely to raise revenues. And the most logical way to raise revenues is through increases in income taxes, because that's where the biggest portion of the federal revenue dollars come from. And so certainly as control of the legislative branches change due to historical precedent, as there might be a change in the control of the executive branch in the future, as those changes are made, I feel it's likely that federal income tax rates will go up. Our clients probably recognize that as well. And so if we have clients who are worried that their future federal income tax rates are going to be higher than they are today, then it makes sense for them to consider Roth conversions, to decide to pay income taxes at a relatively low rate today in anticipation of being able to get tax-free income in the future and avoid taxation on distributions from the Roth IRA later on. So it certainly makes sense for us as we talk to our best clients, particularly our high-income clients, about Roth conversions to take advantage of what might be federal income taxes being on sale today. In the same vein, if we've got clients who have the ability to choose which calendar year to pay income taxes in, and in a lot of cases that's our business owning clients, particularly our C corporation business owning clients, then talking to them about accelerating income if they've got a choice into current years as opposed to putting off recognition of those incomes into later years, that's a fair conversation to have. Client CPA might be on board with that as well. And so that is certainly a topic that ought to be brought up as we make agendas to go visit with our best clients. And then finally, if we're working with people who have substantial IRA balances, and in particular who are also of RMD age, one idea that I think is often overlooked is the idea of qualified charitable distribution planning. Qualified charitable distributions allow somebody who's older than 70 and a half with a substantial IRA balance to send money directly to charity, and it does two positive things. First of all, it doesn't hit their income taxes at all, and secondly, it will go towards satisfying any RMD obligation with regard to IRAs. And so that ought to be considered. If somebody who is 73 or older, has a substantial IRA balance, takes the money in cash instead of using the QCD approach, well, that hits their taxable income, but also has the potential to raise the tax rate on their Social Security income, and also has the potential to raise the premium rate on their Medicare Part B premiums. And so because of all of those factors, particularly if we've got somebody with charitable intent, somebody who's older than 70.5 with a substantial IRA balance, they should certainly consider QCD planning. So let's move on to estate planning. Last year, the estate tax rule was that if we had a single person who was planning around estate taxes, if they had an estate that was worth more than $14 million, their heirs could expect to pay estate taxes on the excess and at a rate of 40%. The One Big Beautiful Bill Act didn't change that much. It raised the exemption amount from $14 million to $15 million, kept the federal estate tax rate the same. So for our high net worth clients, it feels like the rules have not really changed much. And from my perspective, if this is what the government was able to do to modify the estate tax rules, it feels to me like the estate tax environment is very stable, right? It feels like there isn't much that is likely to change in the near or perhaps even medium future in the estate tax arena. And so for high net worth clients, I think that's good news. From my perspective, it means that they should think about making plans, making permanent plans, whatever permanent means these days, but making permanent plans to manage estate taxes that can't be avoided. The tried and true methods for consideration, first of all, making large gifts to family members, certainly updating their estate planning documents if they've been, if those clients have been putting updating their documents off, now's the time, I think, to actually do updates for those documents. Make some choices about portability of the estate tax exemption or unused estate tax exemption for married couples. That might be in the documents, might simply be a discussion. And certainly for those who have an estate tax issue, if they haven't already managed their potential estate tax liability with life insurance in an irrevocable trust, then they certainly ought to consider doing that because it's a tried and true method to plan to pay for estate taxes that cannot be avoided. All right, let's move on to Section 401k planning. For those of our clients who are participants or who are sponsors of 401k plans, it certainly makes sense to go talk to them. There's a new special enhanced catch-up contribution for those who turn 60 through 63 in 2026. It allows them to put in an extra $11,250 into their 401k plans, whereas the normal catch-up limit is only $8,000. So those who are turning those birthdays in 2026 have the ability to contribute a little bit more. For people who are not high income, they've got the ability to put the catch-up money into either the regular portion of the 401k plan or into the designated Roth portion of the 401k plan. However, if we've got somebody who is high income, then the catch-up contributions into the 401k plan must be put into the designated Roth portion of the account. There is no choice. And so the question is, who is high income? Higher income means FICA wages last year were $150,000 or more. And so if somebody ticks that box and they want to make catch-up contributions, whether it's 8,000 catch-up or 11,250 catch-up, the catch-up contributions must be made into the designated Roth portion. And so I think, from my perspective, if you've got a high income person, if you've got somebody over 50, if you've got a business owner who is a 401k plan sponsor, you've got something to talk to them about with regard to these rules, because these rules may affect them or some of their high income employees. All right, let's talk about timeless planning ideas. So if you've heard me talk before, you've probably heard me hit on these topics, but I think they really are important topics to talk about. The first is beneficiary designation review. When I was in private practice, I did estate planning work, and I would typically spend hours with my estate planning clients making sure that their intentions matched with whatever estate planning documents we put together. Um, well, for most clients, beneficiary designations will control the transfer of more liquid wealth at death than any words that we put in their estate planning documents. And that's because beneficiary designations supersede whatever their wills, for example, might say. And so beneficiary designations are really, really, really important. And based on my experience working with life insurance agents and financial professionals, there isn't much time that's actually spent on making sure the beneficiary designations are precise when a product is being sold. And I get it, right? I'm not trying to be overly critical, um, but there's a lot that goes on during the application process, and a lot of times clients are getting a little bit antsy during that process. And so, um, having said that, um, it's a really important thing to do because what kind of business are life insurance people in, right? They're really in the business of making sure that insureds understand that money is going to be delivered to the right family members in the right way in the event of death. That's the idea that they're selling, and the beneficiary designation is a key part of that. And so that's number one. Beneficiary designation review is something that should always be considered, should always be talked about when meeting with clients and offering to look at the client's complete list of beneficiary designations to make sure that those designations match up with the client's intention is one of the most effective things that a service-oriented planner can do. And then the other thing is buy-sell review. From my perspective, if you've got business owner clients who want to make sure that a business succession plan is actually going to work, then reviewing their buy-sell arrangement is really kind of a great thing to help them with. It's really, looking over that buy-sell arrangement and looking over the details of what the client has in place is really a way that you can serve those clients and help protect them from risks that perhaps they don't see coming. Let's talk about both of those things briefly in a little bit more detail. First of all, from my perspective, beneficiary review, many designations, perhaps more than half, are flawed. The most common beneficiary mistakes, first of all, is estate as beneficiary. It doesn't happen that much where the estate is the primary beneficiary. In my experience, estate as the secondary beneficiary, as the contingent beneficiary, is more common. I don't love estate as beneficiary because what it does is it forces the estate through probate. And the life insurance or other financial product through probate, where probate isn't necessary. Probate's public. It requires an attorney. Those of you who have been through it understand this. And also, probate gives creditors a chance at money that they might not otherwise have a chance at. And so, from my perspective, having the estate as beneficiary is almost always a mistake. Second, having little kids as beneficiaries, that's also a mistake, naming them directly. If little kids end up being in line with money or in line for money, somebody's got to go to court to get permission to act on their behalf. And that's a process that is difficult, expensive, and also is inflexible with regard to what happens with regard to management of the money after permission has been granted by the court. And so minors as beneficiaries, that is something to be avoided. There are a couple of alternatives, one of which is using UTMA as your friend in the beneficiary designation that provides more flexibility. Incorrect or ambiguous beneficiary designation language. One of my favorite examples of this is about the lady who tried to allocate 150% of a life insurance death benefit to family members. Obviously, the insurance company wasn't going to pay out 150%. So that kind of thing ought to be avoided, and helping our clients make sure that they've got language that is understandable and clear is part of the process. Sometimes our clients will try to take shortcuts on beneficiary designations because they think everything's going to work without legal intervention. Again, an example of this is another court case where the insured named her sister as beneficiary of her life insurance policy with the tacit understanding that the sister was going to collect the money and use it to raise the insured's minor children. Well, when the insured died, the sister, who was the beneficiary, collected the money but was not going to use it to take care of the little kids, and that ended up in court, and that's a problem, right? Shortcuts shouldn't be taken. Things should be thought out. Things should hang together legally when there's substantial money involved, so that unexpected changes of mind don't end up shortcutting or interfering with what the client's intentions are. On the buy-sell review, I think that it's important if the client says that they've got things covered to ask for a copy of the client's current buy-sell agreement. A lot of times those agreements, if they exist, are outdated, and and in a lot of cases you're going to find out that the client doesn't actually have a buy-sell agreement. They've actually just got an idea of what's going to happen. You've got an opportunity under those circumstances to talk to a client about why a buy-sell agreement is needed. Both the agreement and an idea of how the funding is going to work are critical elements for the buy-sell process. If you're going to do a good job with buy-sell planning, I think if you're a financial professional, you're going to get the client's other financial professionals involved, accountant and lawyer at a minimum. Perhaps other business owners, in order to do a good job with buy-sell planning. Good buy-sell planning is hard. Getting everybody involved is a good thing, and at the end of the day, it's really an opportunity to serve your business owner clients. So as you make appointments to go talk to your business owner clients, make sure that you talk to them about business continuation planning. Let's talk about a couple of free key numbers, and then we'll close out. So numbers for 2026 have not changed that much from 2025. The standard deduction has gone up a little bit. Federal annual gift tax exclusion has remained unchanged. The amount of qualified long-term care benefit that is tax-free has gone up a bit if it's a per diem benefit. You can contribute a little bit more to an HSA, and you can contribute a little bit more to an IRA if you're eligible in 2026 over 2025. Those are all things that you can update your clients on. So what are the conclusions I hope you take from today's session? I think you want to visit with your high income, high net worth clients, especially to explain the new tax landscape and talk to them about the things that are relevant to them. If you've got 401k plan sponsors or participants, you can give them updates about what's happening there with regard to special catch-up if it's relevant, or income-based Roth requirements if they are relevant to the clients. You can talk to them about the updated numbers that might be relevant to them. And then you can also talk to them about timeless planning ideas. So beneficiary review works for everybody. Business continuation planning for entrepreneurs also is something that ought to be thought about. And estate planning in a more robust way for particularly for our high net worth clients. Thank you for joining us today. As a reminder, if you would like to receive the supporting materials I mentioned during the webinar, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's content. Feel welcome to join us for the next webinar on the first Wednesday of next month, April 1st, at this same time. Next month's webinar will be titled Roth Conversions and Rollovers. You can also find an archive of past webinars and past webinars on our YouTube channel, Advanced Underwriting Consultants. If you subscribe to our channel, it will help to keep us making free webinar content. Today's presentation will be presented on our YouTube channel, posted on our YouTube channel by the end of this week. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.